Congratulations on your new gig. You have an eye-opening call, and it's good to have you back. You say we're in the eye of the storm, that things are going to get rocky again, and that a sub S&P 4,000 is reasonable. Do tell.
Yeah, thanks, Judge, and happy belated birthday to you.
Thank you.
Yeah, so I think the call here, we do see downside risk for the S&P 500 and the NASDAQ 100. But I think, if we're looking for an analogy, I think looking back to the 2000 to 2002 bear market gives some clues. I think a lot of people think of that as this big major top where everything went down. And in fact, it wasn't the case. For a 2-year stretch from March of 2000 to 2002, the equal weight S&P was actually up 16%, even as the NASDAQ was down about 60%. So we think there's a call here that you're going to see some rotation, but the cap weighted indices, S&P and NASDAQ, are really where you're going to see the brunt of the weakness moving forward.
Why are we so vulnerable to get sub 4,000? Because of what the Fed's going to do? Because what rates are going to continue to push higher? As I mentioned top of the program, it's nothing new that we're above 2%, but we're holding there today.
Yeah, I think you have to look at it from a macro lens, and the macro landscape is changing. We're seeing, for us, the key breakout in interest rates is global in nature. And we've had 5 or 6 years of range-bound rates in Europe and Japan. We're now seeing breakouts in those regions, and U.S. rates, both nominal and real rates, are moving up as well. And so, that's pressuring the long-duration, high-growth assets. We're seeing it today with some single-stock carnage under the surface. We've also seen it over the last couple of months in some mega caps. Facebook and Netflix are two examples. And so, the names that have been holding out, Apple, Microsoft, Google, they continue to be fewer and fewer. And that's really, what we're looking at. And if you look at an equally weighted basket of the top 10 names in the NASDAQ 100, they represent about 50% of the weight for the NDX. Those have started to underperform the S&P on a relative basis over the last couple of months. So, it's slow for now. That's part of it. And then the other issue is credit, right? Credit markets, if you look at investment grade and high yield spreads, even as the S&P has bounced for the last 2 or 3 weeks off the lows, credit spreads have actually continued to widen out. And so that's really a bit of a concern for us going forward.
Yeah.